Good afternoon, everyone, and thank you for joining our Netwealth webinar today on how to optimize your tax end checklist. My name's Lily. I'm an associate client advisor here at Netwealth, and I'm joined today by Tom Kimchi, our head of advice. During this session today, we'll be covering all the things to consider in the lead up to tax year end and the things to think about going forwards into the 2024-25 tax year as well. We'll first look at relevant points announced in the budget a few weeks ago, whilst also recapping on the 2023 spring budget, where a lot of changes were made that remain relevant going forwards. We'll cover tax rates and allowances to consider before tax year end and for next tax year, as well as looking at how to best utilise wrappers in a case study and the ways in which Netwealth can help with our financial planning and advice services. If you have any questions that aren't answered in the session today, please feel free to email them across to advice@netwealth.com and a member of the team will get back to you. So first, let's recap the 2023 spring budget and how this impacts us before the tax year ends, before focusing on some points released in the latest budget. In the 2023 spring budget, Chancellor Jeremy Hunt announced the pension annual allowance was increasing from £40,000 to £60,000, giving individuals a chance to save more into their pensions each year. He also increased the money purchase annual allowance from £4,000 to £10,000 and increased the income level at which tapering of the annual allowance begins from £240,000 to now £260,000. And even if maximum tapering applies as you're a higher earner, you can now contribute £10,000 rather than £4,000. These changes have allowed people to put more away into their pension and bolster their retirement savings, potentially giving a greater opportunity to achieve their lifestyle retirement goals that they've always sort of thought of and imagined. And there can be some impactful financial planning points and nuances to consider now with pensions in light of these changes. For example, for additional and higher rate taxpayers to claim the extra tax back in self-assessment. Finally, the points from the 2023 spring budget, the LTA was abolished and the maximum tax-free cash was frozen. Looking forward to the 2024-25 tax year, the same allowances announced in the spring budget 2023 apply, and there were also some potentially interesting points from the Chancellor in this budget that I've included here. So these include national insurance contributions being cut from 10% to 8% from April. They've estimated that this will impact 27 million workers and give some an extra £450 worth of savings a year. The higher rate of property capital gains tax was reduced from 28% to 24%. The non-dom tax status was abolished, and there was the introduction of a British ISA. The British ISA was designed to encourage investment into UK businesses and will add an extra £5,000 to ISA allowances each year. However, it's not yet clear when this will be launched and what the exact rules are, so we are awaiting further details to come on this. As and when we receive more information on the specifics to consider with the British ISA, we will of course revert to clients. Now let's take a look at the changing tax rates and allowances. So the income tax rule changes implemented in 2023, including freezing of the personal allowance, otherwise known as a stealth tax, and the reduced additional rate threshold, remain relevant for the 2024-25 tax year. And other taxes to consider for this year is utilising the £6,000 capital gains tax annual allowance if you've not yet done so for this tax year, the 2023-24 tax year, as this is actually reducing further to £3,000 in the coming tax year, so 2024-25. The same is also true for dividend allowances. So this year they're £1,000 and they fall further to £500 in the 2024-25 tax year. Moving on to ISAs. So everyone has a £20,000 ISA allowance each tax year, and it goes without saying that it remains one of the best ways to save, with the returns inside the wrapper free of tax and tax-free withdrawals. These savings and investments can be used for short-term financial needs, but also long-term financial objectives, including things such as supporting your retirement level of income. So if you haven't yet utilised the full £20,000 entitlement with this tax wrapper, it's definitely something you should consider doing before the tax year end on the 5th of April. If you haven't yet used your allowance and you have some funds surplus, this time of year with the tax year end deadline approaching can offer a nice way to quickly get £40,000 into an ISA wrapper in the space of a month. So using £20,000 of your allowance now before the 5th of April and £20,000 shortly thereafter. In terms of family ISA planning, if your partner also has an unutilized ISA and you've got surplus funds to invest over and above the £40,000, as a pair, that £40,000 could then turn into £80,000 into wrappers very quickly using your £20,000 each before and again after tax year end. I mentioned earlier the introduction by the Chancellor of the British ISA. And as I said, more details and further clarity are needed here, but theoretically increases the amount of tax-free savings to £25,000 per individual per tax year. There's also different types of ISAs to consider. So if you have a lifetime ISA, you can allocate £4,000 of your £20,000 overall allowance to this lifetime ISA, and that entitles you to a 25% government bonus. However, there are conditions that need to be met to get that bonus, and it's worth bearing that in mind. So that includes only accessing and using the funds to buy a first home or at age 60 or thereafter. There's also £9,000 JISA allowances, so junior ISA, per child that can be utilised if you're looking at broader family financial planning. But JISAs do come with restricted access before the child turns 18, and once they turn 18, it legally turns into an ISA in their name. Again, there's some nuance that advisors at Netwealth can help with, including the point towards the bottom here about using children's cash ISA allowances of £20,000 at age 16 and 17 before they turn 18, in addition to the £9,000 JISA allowance, meaning for 2 tax years, you can save £29,000 per year. Now to capital gains tax and the importance of utilising these allowances. As I mentioned earlier, for this tax year, the allowance is £6,000. So you can crystallise up to £6,000 of gains before paying 10% capital gains tax if you fall within the basic rate band, or 20% for anything above. It's also worth bearing in mind that you can carry forward losses to reduce the value of the gain and so reduce the tax paid. It's a sensible move overall with this tax year to be utilising your capital gains allowances annually. It is a service that we offer at Netwealth for our clients to opt into for no extra cost. And the point being that utilising your allowance each year increases the base cost of your portfolio and so reduces the value of the cumulative gains that may be building up in your general investment account, thus reducing a potential tax bill in the future. So as the capital gains allowance is set to be halved again in the 2024-25 tax year to £3,000, if you have any unused allowances for 2023-24, it definitely makes sense to consider using them. Moving on to pensions and carry forward allowances. So for this tax year and next tax year, the pension annual allowance is £60,000 gross. You can also utilise any carry forward if you have the relevant earnings from the previous 3 tax years, although it's worth highlighting at this point that the maximum carry forward for the years prior to the 2023-24 increase in the annual allowance will be the old annual allowance of £40,000. If you're unsure of the amount of carry forward that you have or relevant earnings, Netwealth do offer pension contributions advice pieces. Tom will touch on this in more detail a bit later, but for those paying higher and additional rate tax, pension contributions can be a beneficial way to claim the additional 20 or 25% tax relief on your tax return. Tax relief is granted up to the value of relevant earnings, and we have 2 different examples here with 2 different sets of relevant earnings. So in the first example, if you earn £30,000, then the maximum that you can contribute and receive tax relief on is £30,000 gross, which works out at a £24,000 net contribution to then be topped up to the full 30 by the government. In the second example, if you earn £100,000 and have the relevant carry forward allowances from the previous 3 tax years, you can contribute the full £100,000 gross, £80,000 net. Now, depending on the amount you earn, your £60,000 annual allowance may be subject to tapering. So tapering comes into effect if your adjusted income is between £260,000 and £360,000, and it reduces your annual allowance by £1 for every £2 your adjusted income is over that £260,000. This can reduce the £60,000 annual allowance by a maximum of £50,000, leaving the most you can contribute into your pension as £10,000 if you are subject to the maximum level of tapering. Now, adjusted income constitutes here, you can see, of salary, bonus, interest and dividends, and also your employer's pension contribution. So pension allowances and tapering can become quite complicated to work out. And as I said before, it's definitely something we help clients with through advice work. So if you are interested in the clarity and the certainty that comes from taking a pension contributions advice piece, do get in touch. And as I mentioned, Tom will be discussing the advice work available at Netwealth, the associated costs, etc., a little bit later on. So financial planning considerations to be aware of when utilising and going through your tax year end checklist and looking forward to the 2024-25 tax year. ISA allowances. So ISAs are still one of the best ways to shelter your assets from tax, and you can utilise family allowances of £20,000 for adults and £9,000, as I mentioned, for children, and that extra glitch in the 16, 17-year-old children, and potentially an extra £5,000 in the British ISA if we look forward to future tax years. But as I mentioned, we're awaiting more details here. Capital gains tax allowances. So use your £6,000 this year if applicable, and rebase your book costs going forwards on an annual basis to reduce those potential cumulative gain tax bills building up, and bear in mind that capital gains tax allowances are dropping further to £3,000 this tax year coming. Pension contributions. So it may make sense to do an increased pension contribution if you're impacted by the additional tax rate threshold reduction, but check how much annual allowance you have left and consider carry forward allowances from previous years. And finally, remember the inheritance tax threshold remains frozen, something that they implemented in the 2023-24 tax year, and this is another stealth tax, so moving more of your assets into your estate for inheritance tax purposes. So if inheritance tax and passing wealth on to the next generation is a priority for you, then you could consider gifting. So now I'm going to pass over to Tom, who's going to talk you through a case study and some of the advice services mentioned at Netwealth.
Excellent. Thank you very much, Lily. So to continue with the tax year end planning checklist, I'm going to start by looking at a case study. So here I'm going to focus primarily on how you would think about drawing down. Now, if you're not quite at retirement, then this won't be quite so relevant, but hopefully it'll give you some pointers. This section is really useful for people that are actually thinking about taking income out now and just thinking about what their options are and what they should do. So it's a webinar, it's a case study that we use from time to time. It's somebody called Annabelle, and she is 65 and she has just retired. So she had a pension worth £1 million. She has crystallized that into drawdown. So she has £250,000 now in a general account because the tax-free cash has come out of the pension. And now it's in her bank account initially, but she's chosen to reinvest that in a general investment account. So that's one option many of you might have coming up to the end of this tax year. Should I crystallize my pension? I've had clients ask me questions such as, is it worth doing before this tax year or waiting until the next tax year? There's a question to be asked and answered about whether you should crystallize your pension ahead of a changing government. It does depend a little bit on where you are with regard to the lifetime allowance and your wider objectives. But in most cases, actually, it's not that tax year end sensitive whether or not you should take just the tax-free cash because it doesn't impact your income tax in a given tax year. But the level of income you take from your pension can make a difference, as we'll touch upon in this case study. So Annabelle has got her pension, she's crystallized it. She now has £250,000 in the general account, the tax-free cash. Each year for the rest of this projection, the rest of this model from age 65, she'll move £20,000 from her ISA from her general account into her ISA. So she doesn't have any ISAs to begin with, but that will build up over time. As Lee touched upon, now's a good opportunity to use your ISA if you haven't already, and in the next tax year, if you have the cash available, that'll be a good thing to do as well. Annabelle plans to invest in a globally diversified portfolio. So this sort of thing isn't tax year specific, but it is still very relevant in general for your financial plans, thinking about the right level of risk. Annabelle here has gone for a moderate to adventurous portfolio, sensible portfolio for somebody that is drawing income that is retired generally, and her objective is to provide an income for her in retirement, and she would like to pass on any remaining funds to her children. So first we look at a drawdown strategy where Annabelle just draws from her pension first, takes all of her income from there, and then when the pension has run out, she then moves on to her general account or her ISA if the general account has all been moved into the ISA over the years. So you can see that she starts off with £1 million here, and the white line in the middle of this projection is the average outcome, so the most likely outcome we think. And then you can see various shades of blue above and below this white line that represents higher market returns if above the white line, or weaker market returns if below the white line, because of course, unfortunately, we can't say exactly how markets will perform over this period or over any period. But what we see here is the £3,500 per month net coming from the pension and then the ISA. But Annabelle is able to meet her objective because funds do remain at the end. So £330,000 remain at age 95, which is how long we tend to model to. And the funds are within her ISA. So what is remaining is tax-free. Albeit not free from inheritance tax if she has used her nil rate band, the tax-free amount before you start to pay inheritance tax or before your beneficiary starts to pay inheritance tax. So a reasonably good outcome. Annabelle's met her objectives, but could this be optimized with a slightly different drawdown strategy? So on the next slide, we look at a broadly similar position overall, except rather than take the money just from her pension, she instead takes some from her pension to the extent that she uses her basic rate tax band. And by that, I mean the amount of money you can earn or the amount of income you can have in a given tax year while still only paying basic rate or 20% income tax. So currently, that is £50,270 of income. So some of that's completely tax-free, about £12,000, and the rest of that you pay basic rate tax on. So Annabelle is carefully manipulating how much money comes from her pension so that she does take money out, but not if it means paying 40%, so higher rate tax. And the rest of her income needs, if she isn't able to take it from the pension without breaching that amount, she takes that from her general account or her ISA instead. So it's a similar strategy in that she's still invested in the same way. She's still saying she's still paying the same level of fees. She still has the same objectives. It's only the drawdown strategy, which account she takes her money from, that changes. But you can see quite a different outcome and one that's much more positive for Annabelle in the end, or certainly for her beneficiaries. So the general shape of the chart's broadly similar, except the white line is higher at the end. So there's £655,000 remaining at age 95 rather than £330,000 remaining. The other thing to note is that the money is within her pension, which is very important because money within your pension is outside of your estate, your taxable estate, for inheritance tax purposes. So if you can, it's generally more advantageous to pass on a pension than, say, an ISA or a property or something else due to that IHT, inheritance tax benefit. Now, it is worth bearing in mind that if you were to pass away over the age of 75, then your beneficiaries do still pay tax on withdrawals they make, but nonetheless, it is generally attractive to pass on a pension because although your beneficiaries might pay tax at their marginal rate, they still have flexibility as to when they access it. So they might only actually take money out when they're a basic rate taxpayer or a non-taxpayer. So it's still a very good thing to do generally. But overall, there's more money remaining for Annabelle's beneficiaries, and it's in the pension. So how this relates, I think, to people thinking about what to do at the end of this tax year is to review your drawdown strategy if you are retired, and just think about whether you are doing the right thing. So it might be that you have basic rate tax allowance essentially available, as in your earnings haven't quite got up to £50,000 yet, but you can take some money from the pension and you can do that. Another thing to consider for some people is actually, if you have pensions and you're over the age of 55, you might want to consider just taking some money from your pension up to £12,000 of income, because that's also tax-free. So I think most people are aware that you can take 25% of your money purchase or defined contribution pension tax-free, but you can actually take more as long as your taxable income overall is below £12,000. So overall, always good to review your drawdown strategy and make sure it's efficient, but particularly towards the end of the tax year and around now is a good time just to make sure everything's in order. One thing that's, again, not directly related to the end of the tax year, but always good to keep an eye on when thinking about your financial plans, is just the level of fees you pay. And I think this case study is a good way to illustrate that, because we can quite easily adjust the projection, increase the fee level on the new projection that I'm showing you now to show how much a difference that the level of fees can make. So here we show the same projection as the one that we looked at earlier, except this time Annabelle is paying 1% more in fees each year. So all of the risk levels are the same. The drawdown strategy is the same as the most recent slide I just showed you. However, now she's paying 1% more per annum. So she's not benefiting more because of that. It's just the same level of service, same diversification, just higher fees. And here we show that actually just by paying 1% more in fees each year, she actually has 4 years worth of income less due to the fees alone. And that's the compounding effect of this higher fee every single year. So again, it might be that actually she could meet her objectives anyway, but nonetheless, if she was to pay less in fees, the other way of looking at that is there's much more that she can pass on to her beneficiaries. So particularly nowadays, firms are generally becoming more transparent. It's really good to review your fees and make sure you're paying an appropriate amount for the service you're receiving. I wanted to move on now to thinking about how Netwealth can help with guidance and advice. So the first thing I'll do before moving on to the specifics is talk about what we mean by guidance and what we mean by advice. So advice is where we or another company can give you formal recommendations. So that means analyzing your situation in lots of detail, looking at all of your assets and liabilities, income and expenditure, and formally recommending a course of action, whether that's how much you should pay into your pension, how you should draw down from your different account types to meet your retirement needs, or thinking about exactly which type of investments you should make. So that would generally all be advice. Guidance is somewhat related because it does help put things into perspective, but it generally takes less information from you. It provides factual information, but not personalized recommendations, but nonetheless can be really beneficial to people. So let me now move into a bit more detail on each of those two services, how it works at Netwealth, and what the benefit to you as a client or potential client might be. So first of all, when it comes to financial advice at Netwealth, we offer one-off advice and ongoing advice. So one-off advice is an innovation of sorts, I would say, in the industry, whereby rather than you being contractually obliged to take advice on a regular basis or paying for an ongoing service, you just pay for a one-off piece of advice for a fixed fee. So we would typically discuss with a client what exactly they want advice on, which of their accounts, what objectives. We would look at how complicated their circumstances are, and we provide a fixed fee quote that we then stick to. It's based on £200 per hour of our time, and a typical retirement report costs around 10 to 12 hours, something like that, depending on how complicated your affairs are and how much modeling there is to be done. And then once we provide that advice, you can either implement that with us or you can do it on your own. It's actually designed the advice to be implemented anywhere, although of course we'll refer to our portfolios when talking about risk and diversification. You can of course set something up similar yourself if you choose to. We do also offer the slightly more traditional service, which is our ongoing advice. And there we charge 0.35% per annum on the value of the assets we manage. Now, with this, you might receive a similar initial report to the one-off advice. So we'll look at generally your overall circumstances. We'll look at if you're pre-retirement, how much you should invest and how you should invest your cash and your surplus capital. If you're retired or approaching retirement, we'll look at the most appropriate drawdown strategy for you and how you should invest your assets as you move through retirement. So if you opt for ongoing advice, you will typically receive an initial advice that is quite similar to one-off advice, but then the real benefit of the ongoing advice is the fact that you have a meeting at least every 6 months. Of course, discussions may well happen in between that period as well, where we can update our advice to take account of changing legislation or changes to your circumstances. So it could be receiving an inheritance, wanting to make gifts to your children. It could be taking advantage of changing legislation. Of course, there's a couple of big elections here and in the US, likely this year or very early next year. very hard to say what might happen there, but it is likely there are some changes and some tinkering that might need to be done to your plan to keep it on track. So generally speaking, the more complicated your circumstances, the more likely this is to be of value. But it's quite interesting, actually. Often people with relatively simple circumstances, or people actually know quite a lot themselves, benefit from this service just for peace of mind and just so that they feel that they don't have to stay quite so tuned in themselves to changes in legislation and things like that. Um, in terms of the formal advice, we do also offer some fixed cost advice packages, and you can see them at the bottom of the slide here. So we have a pension contributions package that looks specifically at how much a client can contribute. And this is particularly relevant for high earners that have a tapered annual allowance. So if you're earning around £260,000, say, there's quite a complicated calculation that works out how much you can pay in this year, but we can also look for you at the previous 3 tax years to let you know how much exactly you can contribute this year. We charge £400 for that one-off piece of advice specifically on that topic. And we also have a drawing down package, which is similar to a general retirement report, except it's specifically focused at people that just have a pension, an individual looking at how they access this pension, how much income should they take, what are their options, and what does that look like moving forwards with the investment of the subsequent pension. So if this sort of thing is of interest, a good first step is normally just to get in contact with us at advice@netwealth.com. We're very happy to talk through this with you in more detail, give you a fixed fee quote if it was some one-off advice you were looking at, but certainly let us know and we'd be very happy to go through that with you. Um, and then we also have a relatively new guidance service as well. So this is somewhat similar to a financial MOT that you might have with your car. So it's thought of as a once a year check-in where you will speak with a Netwealth advisor about your plans. You can look at some modeling in a somewhat similar way to the formal advice service, although it's done on a slightly more generic basis. And it provides a regular point of focus for your financial position and goals. It gives you a sense check on your overall asset allocation, tax efficiency, how much you're saving overall, and how likely you are to meet your financial goal. Adjustments can be agreed and made to the plan. Important actions in your life, such as the starting of the state pension or the starting of defined benefit pensions, will all be taken into account and discussed with your advisor. And the fees for this are a little bit lower because it's not a formal personal advice service. So it does, of course, look at your specific accounts and your level of assets, but you're not receiving with this formal recommendations. So the level of fee is slightly lower. So if it's an individual looking at their financial MOT, that's £400. And if it's done on a joint basis, that is £600. So again, the first step there generally is just to get in contact with us and discuss with us that you'd like to take us up on that offer, and we'd be very happy to send you the next steps. So before I move on to some questions, which I'm sure quite lots of questions have been coming in. Lily will present some to me shortly, but we think it's really important that, especially coming up to the end of the tax year, probably the most important thing is using your allowances and your family's allowances. So the ISA and CGT allowances, they are lost if they're not used. So very, very important indeed to use those ones. Even pension allowances, also important to use. You can carry back pension allowances from the last 3 years, but from the 4th year, that one's lost. And it can be quite complicated staying on top of that. So generally speaking, it's good to use the allowance each year. And of course, the sooner you use your allowance, the more you benefit from that tax-free growth if it's a pension or ISA. So it's generally a good thing to do to use it ASAP, assuming the cash is available. So using your allowance is a good opportunity to review your wider financial plan and the level of risk you're invested with. Now, you should do this every year anyway, but it makes sense if you're coming up to the end of the tax year and you're thinking about your finances. And finally, getting financial advice or getting some guidance can really help improve things and make sure that you're on the right track. So certainly get in touch with us at advice@netwealth.com if that sort of thing would be of interest to you. I'm going to pass now back to Lily, who I believe has some questions.
Yeah, thanks, Tom. Useful summary. Just to mention as well, as I should have at the beginning, a recording of this session will be sent round afterwards. So if you missed parts, turned in a little bit late, or want to go over the slides again, I realised some of the ones at the start were quite information heavy. So if you didn't have a pen and paper to hand, you will have the chance to do this, and it will be circulated afterwards. So we have had some questions in. Firstly, a good one from someone who has mentioned they've got some spare funds to invest before tax year end, and how to best decide the mix of where to put these funds between pensions, ISAs, and potentially a mortgage repayment as well.
Yeah, it's a good question, and I'm glad they mentioned mortgage repayments actually, because that's always worth thinking about, particularly now when interest rates are much higher than they have been over, say, the last 5 years. And there's lots of talk of interest rates being cut this year, and it's likely they will be based on what we know today. But nonetheless, for a lot of people that are coming up to remortgaging, it's likely that the interest rates they're being offered are much, much higher than where they were previously. So I think addressing that point first of all, um, I mean, quite a simple thing, but a very important thing is the fact that by choosing not to pay for your mortgage and choosing to invest instead, you're essentially choosing to keep some borrowing and to invest elsewhere instead. So it does slightly increase the risk of your overall strategy, because if interest rates were to increase further or markets were to perform poorly, you've got the double whammy of lower returns, which you're not happy with, and you're paying more interest. So that's an additional risk that you've presented to yourself there by choosing to do that. But it can sometimes work out well in the long run, because generally you would expect to invest to receive a higher investment return than the interest rate you're paying. Um, but for a lot of people, they're keen to reduce their debt, to reduce that level of risk, and to take on investment risk once they've started to clear most of their mortgage, particularly when interest rates are much higher than they have been. So I think for a lot of people, paying their mortgage, particularly if the rate's about to go up a lot, is it going to be a good thing to do? But the caveat to that is, for a lot of people, particularly in the UK, with pension savings, your employer is quite likely to match the amount you pay in. So that's very attractive, because not only do you get the tax relief, but your employer also pays some extra in that they might not otherwise. So that's generally a very good thing to do. Um, Beyond that, if you're, say, somebody who's quite close to retirement and you have a lump sum, I think often then being close to retirement, the pension is the most tax efficient, because you get the tax relief. It's outside of your estate for inheritance tax purposes, and you're not too affected by the lack of flexibility that's often a problem with pension contributions, because if you're 54, say, you can access it next year. Um, so I think generally it's good to use all of these allowances. Pension's the most tax efficient generally, but for younger people it means a complete lack of flexibility. So it really depends on each specific person. But pensions are generally the most tax efficient. I think that's how I'd answer that one.
Yeah, thanks, Tom. And then we had another one regarding sort of the LTA and fixed protection, obviously with that
Mm.
then being abolished. So if someone has fixed protection, can they make contributions now that it has been abolished?
Yeah, they can indeed. So there was a period that's now ended whereby if you had made a contribution, you would lose some of the benefits. But now you benefit from your higher level of protected tax-free cash. Of course, one of the main advantages of fixed protection originally was that you were protected from the fall in the lifetime allowance in terms of paying this punitive lifetime allowance tax charge if you exceeded it. So that doesn't apply anymore. But nonetheless, with the fixed protection, you have a higher level of tax-free cash, which you're still protected from, even if you continue to contribute. Um, so yeah, it's certainly worth doing, but the main benefit for you by continuing to contribute is really the fact that the money's outside of your estate for inheritance tax purposes, and it grows tax free, but you don't benefit from any more tax free cash. So just important to be mindful of that.
Yeah, thanks, Tom. Some useful points there. So I think that more or less covers the questions that we've had come in. If you do have any more specific questions that you don't feel like have been covered in the session, or you'd just like to speak to someone about your specific circumstances, then as I said at the beginning, please do reach out to advice@netwealth.com, and a member of the team will get back to you on your specific circumstances. But otherwise, thanks for joining, and I hope everyone has a lovely afternoon.